Welcome to the 2025 Burney Town Hall. Ask us anything. So we've got representatives from the three branches of Burney right now. We've got Andy from the investment team, Rhonda from the tax team, and I'll represent the wealth management group. And we did this last year for the first time, and we had a lot of fun. We got great questions. Throughout the year, we normally have webinars on various specific topics, whether it's a quarterly investment review or a webinar on healthcare or estate planning that are really targeted. But we get questions that oftentimes cross a lot of those different topic areas, and questions come up around year end, and it's a nice clean way to kick off the year, addressing any questions you have and make this a really nice open conversation. And so we'll go through some of the housekeeping items around how to submit questions. You've got really two options. The first is right here on your screen now through the tool we use, Slido. You can scan the QR code on the screen. That should direct you immediately on your phone to the Slido homepage where you can submit a question. If you have any difficulties with that or want to do things the old-fashioned way through the Zoom chat, that's absolutely fine. So you should see on the Zoom toolbar a chat option or a Q&A option, and you can type in your question there and we'll have access to it. So we had a nice list of pre-submitted questions, and we know that there will be more that come up along the way. So with that, we're kind of just going to jump right into it. Is that okay?
Yeah, let's dive in. Yeah. The agenda is Q&A, and then we're going to give Rhonda some time to talk about Burney tax advisors. But yeah, let's jump in. So I'll be moderating the questions, and we'll start here with the one that's at the very top. With a 5 or 10 year time horizon, where would you be investing is the question. I think maybe you and me, Adam, will both have answers to this.
Sure.
I'll start from an equity standpoint. So this is a really interesting outlook, 5 or 10 years, because obviously the US stock market has done so well over the last 10 years. At the same time, though, we've seen valuations rise. There's a couple questions later that we're going to address that in more detail on. And so we're seeing historically relatively elevated PE ratios for stocks in the US. So I think it's an interesting time for forecasting over such a long time frame, because valuations themselves are not really good predictors at what's going to happen in the short term. So it's not going to tell you really much of anything about what's going to happen in 2025. But over longer time frames, we see more of a relationship there. And so the relationship right now is saying that, hey, US stock returns may not achieve what they achieved over the past 10 years. So I think it's a really interesting time. And I think what's really driving that is large cap stocks look especially overvalued relative to smaller companies as well. So investing over the next 5 or 10 years, I'm not sure you're going to be able to get away with just investing in the Mag 7 top 10 stocks in the S&P 500 and calling it a day. Goldman Sachs recently forecast 3% annualized returns for the S&P 500 over the next 10 years. That's probably an especially bearish forecast, but if it comes to fruition, that's barely beating the long-term rate of inflation. In that same forecast, though, they did project that the lower 490 in the S&P 500 would achieve much more typical stock market returns. So I think it's going to really pay off from a US equity standpoint, investing down from the very biggest stocks. I don't know if that's going to necessarily pay off next year or the year after or what have you, but over the next 10 years, I think you're going to want to have exposure to the entire stock market, not just the top 10. I think there's some interesting things from an asset allocation standpoint too, Adam. I'll let you dive into that.
Well, I think if you go at the last 10 years in the context of asset allocation, you felt, kind of the same level of pain with, you've got fixed income, international equities, other asset classes that haven't been as exciting from a return standpoint as the US large cap stocks. And if you think about the reason why you diversify your portfolio and why you include other asset classes, a lot of it has to do with, hey, I want to achieve a reasonable rate of return, but I don't want all the excitement of the ups and downs of the stock market. And you've gotten some balance from asset allocation the last 10 years, but the return from a historical perspective has leaned on the lower end just because of what's happened in the performance difference between large cap stocks and everything else. And that everything else isn't just other stocks, it's other asset categories. So if you're thinking about the next 5 to 10 years and where would you invest your money as it pertains to asset allocation, I think the first question you have to ask is what's going to be changing personally over the next 5 to 10 years? Am I retiring? Am I going to start drawing down my portfolio? Am I hitting a new phase of life where my risk level should be changing? So I think that decision always needs to lead with that perspective. But outside of that, as someone who is diversifying and investing in other asset classes, I would be pretty excited, because you finally have fixed income offering a real yield, a yield over and above the rate of inflation. You've got some hope for a rebound in global equities. And then you've got other alternative asset classes, if they're appropriate, such as private credit, trend following, asset classes that tend to actually do really well in a more volatile, flatter US equity market type environment. So I would lead with the personal side and then think about all the other asset categories. And then I would look at that through a more optimistic lens.
Yeah, it's awesome. But we'll leave that there and I'll move on to the next question here. So this is going to be a little bit of a different angle here, but what are the benefits and negatives of bequesting to a teenage grandchild? I think there's probably a tax angle to this question, as well as maybe some more planning related things. So Rhonda, I'll let you kick us off here from the tax angle.
Okay, so for a tax angle, if you're giving a contribution to a grandchild, the things you might want to consider are there are annual limits that could possibly result in filing a gift tax return. So it's just those types of things to keep in mind. How much can maybe a taxpayer and a spouse contribute before they have an impact, that they're impacted with a gift tax filing?
Yeah, gift taxes can be incredibly complicated. That ties in with your lifetime gift and estate exclusion amount, which is currently 14 million per individual. Roughly, it's like 13.99, 28 million if you're a married couple. That's the number you have to track against during your lifetime. But then you have this 19,000 a year per person per beneficiary gift exclusion. So you definitely have to think about the tax consequences when you're making a gift. And as it pertains to teenagers, to get specific with the question, there's two pieces of this. There's the qualitative and the quantitative, and focusing first on some things we run into when clients have made gifts to teenagers in general, whether it's a kid or a grandkid. You have to think about first and foremost, are they going to be ready to inherit this asset, right? What's the dollar value that they're going to be coming into? Are they ready for it? That can be really hard, and you never know ultimately when you're going to be passing these assets on. That's the tough part with planning. We never know when we're going to go, but they have to be ready. And you hear stories, you read stories of wealth that's passed down to the next generation and frivolously blown and not handled prudently. And I think with a teenager, you just have to have your radar up even more in that regard. So are they ready for it? It's a really big conversation I'd want to have. Outside of that, there's a lot of, and depending on the type of asset you leave them, whether it's a retirement account or a taxable investment account or a piece of property, there's a lot of legal considerations that can be very state specific with bequests to grandchildren, especially minors. And so it can't just oftentimes be as simple as, hey, I want my 16-year-old granddaughter to inherit this. The courts might get involved. There's different legal maneuvering that needs to happen, and it might not play out the way that you would anticipate when you're thinking about that gift. So I would think about, are they ready? I would think about really having a conversation and getting legal and tax counsel on the strings attached to it and what might come in your way. So that's not something I would do without counsel. First.
Yeah, it seems like something you'd want some experts on to help you out with, whether that's counsel, your financial planner, your tax advisor. There's so many different angles there.
Yeah,
with that to consider. Well, that's great. I'll keep on moving down the list here. So I've got two questions. We did have an election this year, and I have two questions that sort of have like an election theme that I'm going to get to next here. The first one is pretty specific to us. It's how will Burney's size and style model adjust for potential market volatility in 2025, given a potentially tenuous political climate. The other one is how will the incoming administration's agenda impact the stock market? So, I'll talk about just the general stock market first, and I'll get into some of the things that we may or may not be doing with our specific strategy. But we ran a webinar back in August where we talked about 8 surprising facts about the election and its impact on the stock market. And what typically happens with elections is there's all sorts of ink spilled about what's going to happen. There's going to be a new agenda, a new administration, new policies, and such forth. And when you look back at the history of all these elections, we've had, Republican control of Congress and the White House. We've had Democrat control of Congress and the White House, and all sorts of things in between. And the stock market really just keeps chugging along. The economy keeps on chugging along. There's just so many different things that will impact not only the economy, but also the stock market that go beyond politics and policy, that it's really impossible to say with any sort of certainty what one particular administration is going to have, what kind of impact that's going to have on the stock market. I think sometimes what ends up happening is the opposite of what people expect. So like when Obama was president, we saw gun stocks do really well. We saw the top performing stock when Trump was president the first time was a clean energy company. And, with Biden, we've seen energy stocks do really well. So it just can be so uncertain how the impact's going to be on the stock market. Talking a little bit about, our models specifically, we really don't adjust what we do for a political environment. We will adjust based on volatility. So I will say that, just the nature of how we go about picking stocks, we tend to lean into profitable companies, high quality companies, things like that. So when we do face market volatility, we are exposed to the downside, but we're protected somewhat from maybe, the stocks that are just sort of hanging on there. The companies that are just sort of hanging on there from a debt standpoint or just from a going concern standpoint. I will say that when we do get the opportunity, for market volatility, when the market does sell off, we do certain things to exploit that opportunity. So we don't view market volatility necessarily as a negative thing. Of course, no one likes to see that their accounts go down, but market volatility creates a ton of opportunity to pick stocks that were beaten down. So I wouldn't worry too much about market volatility moving forward. I would say that if you are concerned about your portfolio dropping, it's a fair question to ask. Are you in the right type of asset allocation? Are you overexposed to risk assets? And then I think that's a good time to talk with the team over on the wealth side, like Adam and his team over there, just to have a conversation to see if there's certain adjustments that need to be made. Do you have anything to add there?
But they say, the market moves not because of who's in office, but the markets move in spite of who's in office. And there's just we've got a lot of great anecdotal evidence. You see, we've released all the different charts around, what moves up and down based on the administration. And I think even across asset classes and for diversified investors, the same principles hold true. It's just oftentimes the opposite will happen in terms of what you're expecting for a president. So we totally agree.
Yeah, absolutely. All right, so we'll keep jumping around topics here. Everyone's favorite topic, annuities. I guess there's been some concern about annuity performance in this past year, despite it being a strong year for income yields. There's all sorts of different types of annuities anyways. So Adam, when we think about annuities and their place in a portfolio, like when does it make sense? When does it not make sense? Like, what are the pros and cons here?
So annuities come in a lot of different flavors. It can be a little bit like the wild, wild west, right? There's no annuity just thrown around. It's like a catch-all term, but there are a lot of different variations of annuities. There's variable annuities that move up and down with the underlying investment values, and then there's fixed annuities that are, fixed payout amounts, and those are most closely tied to the interest rate environment that we're in. So in terms of just annuity yields in general, I would say fixed annuities over the last couple of years have seen improvement in their yields based on the Fed hiking rates and rates staying relatively high. And variable annuities are going to be all over the place, depending on the underlying investment and the insurance company that issued them. In general, our stance is when you look at annuities across the board, they tend to be really expensive. They tend to put you in a position where you lose control over the liquidity of your assets. they're oftentimes not great vehicles to inherit. So if you're passing this on to future generations, that can be a huge headache. And we're all about flexibility. Annuities will in most cases lock you into a decision for a long period of time. So they can have their place in instances where someone is really at risk of running out of money and they need to take this this lump sum and be guaranteed some sort of income stream, even if it's less efficient than a diversified market-based portfolio. But other than that, and for our clients, we try to look at things through an open mind and an open lens. But given all those constraints, we're certainly typically not in the camp of annuities being appropriate.
Yeah, that's great. Real quick, I'll pause here. Thank you everyone for giving us questions at the start when you registered. We had about 20 questions come in for registration. If any questions pop up while we're talking, feel free to scan that QR code that's on the screen. You can ask questions directly into this tool. You can also use the chat feature on Zoom as well to ask questions. Just want to make sure everyone understands how that works. So we've been talking, a lot here about investments and planning topics. Let's get back to tax for a second. I think we had some people asking for more information about our tax group. Who's eligible? What does it cost? So Rhonda, I'll let you jump into all that.
Fantastic. All right. So for those of you who don't know, we launched Burney Tax Advisors in July of 23. Our primary focus is tax planning, followed up with tax preparation, and then IRS and state resolution. But we feel with the emphasis that we put on tax planning, we're able to, and the collaboration with the investment team and the wealth management team, the different strategies we're able to work together and collaborate. We've been able to project into the future and help minimize taxes for our clients. And our clients consist of Burney clients and then also clients who are not with the Burney group that we hope will be with the Burney group someday. But it's not limited to just Burney clients. How we are based, we are fee-based, based on complexity and the number of tax returns we actually prepare for you. So the best way to find out, what do we charge, how do we bill, is just to schedule a meeting with our team, and we'll be happy to go through that with you. So
yeah, and on the tax topic, we got questions, and we always get questions about the political environment and the stock market. That's all we need. But I've gotten a lot of questions about, hey, there's a change in administration. What does that mean for tax policy? Is anything going to change from a tax code perspective? And just to kind of play out what this looks like in action is, and how the different teams work together is, if there is a change in tax policy, or if we're concerned about certain things coming through the pipe, it's great having that open collaboration to say, okay, we think tax rates are moving in this direction, the estate exemption is, changing, or any other tax variable. We can work together as teams, and then throw in the investment team on top of that to see how does the portfolio need to change to account for all this. So I would say more so than we're thinking about what's the stock market going to look like post a new president. I think there are some exciting tax things that can end up happening, and as always at the very last minute, right?
right, exactly.
Sure.
So,
Well, let's get into that a little bit then. You mentioned estate and investments. Let's start with estate then. So I think estate planning is a topic that is like wonky for everyone. It can be difficult to think about. And there's all sorts of different strategies that can be put in place. So a question that I think we get pretty routinely is, how should I go about determining which estate planning options, like wills and estates or whatever, are right for me?
Well, I think we had a really good webinar at the end of the summer with a law firm that we are one of our partners for estate planning. It's on the Burney Wealth website under the resources tab. It's really just like the ABCs of estate planning. So I'd really encourage anyone interested to look at that. It's purely educational and goes through some of the documents that I'll reference. But I kind of break estate planning into two different categories. There's your basic foundational estate documents, and then there's advanced estate planning. So everybody should have their basic foundational estate documents, notarized, signed, executed, and reviewed either once every few years or as life changes. And these basic documents are your wills, primarily your wills, and your medical and financial power of attorneys. So these are the documents that say, you know, hey, if something happens to me tomorrow, I want my assets to go in these different, you know, my assets to go to these individuals or parties. And if I become incapacitated or not able to make either medical or financial decisions on my own, this is who I'd like to step in for me and take on that role. So that is foundational for everybody, from a young family all the way up to, you know, a really high net worth retired married couple, right? Everybody needs that. The more advanced estate planning topics, it's going to apply to those with, in most cases, the states that run into the 28+ million federal estate exemption amount, or if you live in a state with if you live in a state that has an estate or inheritance tax, that adds some additional wrinkles as well. So once you get, I find in general, once clients get to the 10 million and up range in terms of portfolio size, that's at the level of net worth where they start to straddle in between the two, and you start having the conversation about more advanced estate planning topics to get ahead of the curve. But that webinar is a great resource, and I'd say our advisors are well equipped to have these foundational conversations with you, pointing you in the right direction.
Yeah, that's a great plug. Yeah, BurneyWealth.com is where you can go to find all sorts of resources, including that webinar that Adam just referenced. So let me move on here, and I'll keep jumping back and forth on topics here, because we got a question that came through. Someone just published. Let me go ahead and push that one through. I'll go to the most recent one here. Oh, sorry, 1 second here. All right, so the question was about, do we get a sense that we're overvalued, or that, you know, we're approaching bubble territory? And I think it's certainly like a scary thing when we talk about valuations in the S&P 500 being as high as they are. You know, the last time we saw, you know, valuations and the very top stocks outperforming everything else, you know, it brings back memories of the late 90s and the dot-com bubble burst. So there's a lot of, you know, I think, hand-wringing about that. You know, I would say that we're probably a long ways off from a bubble. When I think about bubbles, I think about manias, I think about things like prices that can't be justified. You know, I would say if you're looking for a bubble right now, cryptocurrency sure looks like a bubble. You know, with the price of Bitcoin hovering around $100,000, it just, you know, that happens from time to time, and it happens very quickly in crypto. But when we're talking about the general stock market, yes, you know, the Magnificent Seven stocks have an average PE ratio of 30, which is high. Historically, the average PE for the S&P 500 is 15. You have to keep in mind that these stocks really do justify those valuations. They are incredibly profitable companies, which is a big difference from the big companies in the late 90s. They're growing at just outstanding rates that almost seem impossible. I kind of call these companies unicorns because of how fast they've been growing. And so, you know, assuming that they're able to keep these types of results up, their valuations levels are actually totally justified. We had another question come in about what's a realistic PE multiple for 2025. And, you know, I would say that there's nothing that forces the PE ratio necessarily to fall this year. I think it's up around 29 for the S&P 500. But that's biased to the very biggest stocks. The very biggest stocks have such an outsized impact on the S&P 500. When you look down below the hood, underneath the S&P 500, you see a lot of companies that are much cheaper. PE's more around the 18 I think for the bottom 490, the PE ratio is 18, which is a little bit elevated, but not that different from the historical long-term average. And so I don't think we have to worry about bubbles here in the US. As far as the projection goes, you know, PE can be difficult to project. The forward-looking PE is more like 24. You know, so I think that there's the expectation that can PE expansion continue? It probably will be somewhat limited, but earnings can keep increasing, and that means that stocks can continue advancing even at relatively high multiples.
And we're also looking at a window where, you know, like you said, earnings are still growing, but also, you know, everyone hears about AI and what's happening and how rapidly artificial intelligence is making its way into the bottom line. for these larger companies now, we're in a wave of really productivity growth right now that we haven't seen in decades. So we already have new tools at our disposal that are making us more productive. A lot of that emphasis has been on the biggest companies in the last 18 months, but you're going to start hearing more about that with your regular role, plain vanilla profitable businesses and productivity growth. I think it's going to be a huge win behind the sales of just the economy in general.
Yeah, great point. And I appreciate the questions rolling in. Keep them coming if you've got more. All right. So one other topic here is we can stay on the investment front and the sort of the macroeconomic front is we had a bunch of questions that were concerned about inflation. You know, how will projections for inflation impact our portfolio management? How does our strategy take into account inflation? You know, it seems like inflation is persistent and stickier than hoped. How would the Fed target rate being higher impact long-term returns? So I'm going to group all these questions sort of all together here and just address the inflation thing head on. So certainly back in 2022, inflation was the thing that was driving stock market returns. And it spiked, you know, beyond levels that were comfortable for anyone. And the Fed had to take really aggressive action to counteract that inflation. But now we're at a point where inflation, it's a little bit elevated. It's in, you know, probably the high twos if you look at, you know, annualizing out the most recent numbers that we've been getting. And that's slightly higher than the Fed's 2% target, but it's certainly not emergency you know, there's no alarm bells going off. So I think that with the incoming administration, are there concerns about tariff policy and immigration policy and how that's going to impact inflation? Yes, there are concerns about that from economists, but that's going to be counteracted, at least to some extent, by other things like decreased regulation coming on. So it's unclear how those, you know, two competing, you know, pieces are going to be interacting with each other for the inflation picture. I will say that when we look at the outlook for inflation, there are a lot of headwinds to inflation that are driving it lower. The biggest one is shelter. The cost of shelter makes up 40% of the core PCE number, which is it's, you know, one of the biggest drivers of inflation, and it's sort of like artificially showing a high number in the official statistics by the BLS. And the reason for that is they use like a smooth rolling 2-3 year measure for inflation. It's why the Fed was a little slow to react back in 2022 because the lagged, you know, shelter inflation number wasn't picking up real-time information. But now it's showing us like an artificially high number. And so if you substitute more real-time inflation numbers in, like Zillow has a great resource for shelter inflation, core inflation is actually below 2%. Which leads me to think that, you know, that's going to be one of the things that's really driving inflation lower. So the Fed's going to be cautious. I think from our strategy standpoint, you know, we're watching the inflation story because if the Fed keeps rates higher, that's going to probably be a headwind for small and mid cap stocks. But if they start to drop interest rates and it becomes clear that inflation really isn't, you know, as much of an emergency, and once they get more comfortable with the new, you know, administration and their policies, I think we could see small and mid cap stocks really begin to advance, assuming the Fed continues cutting rates. So that's sort of my take on inflation. And, you know,
well, and I'd say this is like the whole inflation conversation is a great example of like no economy will ever be good enough for everybody. You know, like if I would tell you, hey, next year we're going to have sub 3% inflation, 4% unemployment, and roughly 3% economic growth, you'd be like, sign me up. Like that sounds great. Like that's you know, from it just like purely from a health of the economy standpoint, who would not be excited about that? So it's funny how little things get attention. You know, we've gone from, you know, like you said, 9 down to below 3. I mean, look at all the other pieces and how they're firing. You know, we're kind of firing on all cylinders and trying to nitpick, you know, what might be wrong under the hood.
And it's really easy to nitpick the Fed too, right? And, you know, maybe they're a little slow, but it seems like right now anyways, we're back on that soft landing topic. Certainly. So we'll see what happens there. So as I keep going through these questions, you know, there's some questions that sort of intersected investments and tax. So, you know, one of them that came through maybe in a couple different ways here is, how do we minimize tax on a taxable investment? You know, what kind of investment strategies do I need to do to generate, you know, income? So this is, you know, we're talking about the way that we structure a portfolio at this point, because certainly there are certain things we can do. And Rhonda, maybe you can talk, about, some of the strategies and how, you work together with us on the investment side to try to minimize taxes as best I can, or as best we can. But I think that the big thing to think about when it comes to minimizing tax and taxable investments is just make sure that you're putting tax efficient investments in taxable accounts and more tax inefficient investments in IRA accounts, or tax deferred accounts. So I think one of the mistakes that we see people make here is they're really focused on income and yield, and they're putting some really tax inefficient investments in a taxable account. And so they're paying quite a bit of tax on things like interest income, when that could be sheltered in an IRA where it's not being taxed. One of the things you can do with your taxable money is, instead of having, a portfolio of individual stocks, you could own an ETF, and we have a solution for that as well, for Burney clients. But as far as like strategies go, Rhonda, when it comes to you and us, when you're working with your tax clients, and they're also working with us on the investment side, what are some of the things that we do together to help clients with this problem?
Well, I think the biggest thing that we do is with the tax projections on a quarterly basis. Most often, a lot of CPA firms, tax planning falls by the wayside. They're focused on tax preparation. Once they get through season, they're working on filing extended returns, so there's very little time for planning. Our focus, as we say over and over again, is planning. We truly do projections on a quarterly basis. So when I am requesting information, my team is requesting information from our clients, we're not waiting till the end of the year to look at tax loss harvesting. We're doing that on a quarterly basis. So it's that constant collaboration with the investment team to say, here is our current projection. Is there anything in the portfolio that we might want to get rid of now, so that we can bring the quarterly tax burden down? And I would say other things we're looking at too is we're constantly asking questions of our clients. We're not just looking at year over year, what happened last year, and assuming the same thing happens this year. So in our quarterly meetings, which we're heavily into right now, because not only are we getting set up for tax preparation for tax year 24, we're looking at first quarter estimates for 25. So reaching out to the clients, we're actually doing what they call tax checklist meetings right now. And finding out what is going to happen in the first quarter of 25, so that we're not using what they call a safe harbor calculation to just pay taxes. We're actually dialing in on what is your true tax liability for that first quarter. So those are some of the things we do to minimize the tax for our clients to pay the least amount they have to.
And we emphasize, lifetime tax planning
Yes.
so much. If there's, we kind of like live in the moment, and every year becomes its own little tax planning window that we think about. But as we're prepping for 2024 filing season, part of our job is to zoom out and say, hey, we're not only thinking about this year, but what else is happening down the road that we need to plan for. And tax planning can be very cyclical. Some years it might make sense to do things like Roth conversions, and other years it doesn't. So it's very unique and specific to the individual. And it's you're really playing the long game. And I'd say collaborating together, like one of our jobs is minimizing the element of surprise, right? And so no one likes tax surprises. There's probably nothing worse, because no one likes paying taxes, and no one likes crossing their fingers and waiting for their tax bill to come across their table. So I'd say an overwhelming majority of the year-to-year in the moment planning revolves around, trying to eliminate to the best of our ability the surprise element with taxes.
Yeah, I think there's some really innovative, things, just to take a quick investment detour here on this as well, that are happening out there that I see in the ETF landscape. It's becoming more and more popular if you have, a taxable account that's got, it's diversified maybe, or maybe it's got a few stocks that are a very low basis, and you feel trapped by your investments, that, it's possible now to convert a separately managed account over to an ETF. And it's becoming more commonplace where we're seeing this out there in the market. So we may have more news on this front in the future. So it's something that, as you're talking to your advisors about it here in the first quarter, when you do your review meetings, this might be something to bring up if that's you. All right, so you mentioned, in your answer there, Roth conversions. We did get a specific question on that too. So when do Roth conversions make sense? You mentioned that it, it may not always make sense year to year. When do they make sense? And, what other types of tax strategies are there that clients can take advantage of?
What do you think? We could probably go like, what are some of the character, if someone were to say, describe to me a great year or a great set of circumstances to make a Roth conversion, what would that look like? Would it be?
It would be, for the first thing we're looking at is where's your income?
Right,
So
what's your other
if you're in
income?
the highest income tax bracket, a Roth conversion makes no sense.
Yeah, probably
So
not.
we're definitely looking at, where are you income wise? I think that's the number one thing we look at. But also folks will say, maybe they don't qualify, but they want, well, I guess the other thing is, I'm thinking if you do a Roth conversion, it also increases your income, which can affect a lot of other things. For
Yeah.
instance, if you're at a certain age range and, it impacts the IRMA,
For Medicare
for Medicare.
purposes, yeah,
Right, so, yes, we do, so it's hard to say, do you just do a Roth? You can't just look at one item, we're looking at all the other types of income they have in that year.
Yeah.
And just running various scenarios and analysis, and also asking questions, what does next year look like? Because maybe you're retiring next year, your income is coming way down, next year looks a whole lot better for the Roth.
Definitely.
Versus this year.
Yeah, the typical characteristics that make a great Roth conversion year are your income is lower, whether it's because you retired, you took a sabbatical, or you're going through a job transition, right? A lower income year is a great time to look at it. A life transition such as retirement, is another big one. So those and thinking about not just this year and even next year, but several years down the road, we've got plenty of clients that are still making tax deferred contributions to accounts like 401k with the understanding that, okay, I'm retiring in 5 years. Maybe that's a good time to do a Roth conversion. So I think that those are like that for Roth conversion specifically, that's the general makeup of when it usually makes sense. And then other tax strategies, right? I mean, like tax strategies in general are so specific. We get this question all the everyone wants that silver bullet. Okay, what's that one tax strategy that's gonna, solve all my problems, and then some. But it's not just that one thing. Right? It's just
I think the one we did last year that it was super successful, and we're still doing a lot of that this year, is we're finding a lot of our clients have a side gig, a side hustle of some kind, and they're making actually a lot of money doing it, and they're set up as a sole proprietorship, which means they're paying self-employment tax.
mhm,
So we run the analysis, should you stay as a sole proprietor, or should you perhaps convert to an S corporation? And then we're showing them the difference. If this is the long run and this is what you're gonna do for a while, does it make sense to become an S corp versus staying as a sole proprietor? So that's been super successful in
Definitely.
a lot of our clients, converting them over.
yeah, that
So-
and also, clients that are charitably inclined. If you're making charitable gifts, there's a ton of different strategies you can implement that are the best of both worlds, making an impact and solving for taxes. What you want to do for your family, kids, grandkids. So there's a conversation that needs to be had, and it's our job to put the pieces together and determine what tax strategy makes the most sense. And we certainly can and will do that. I'll also just say, generally, if you look at the makeup of the tax code today, in the late 80s, up to the late 80s, there was all these different loopholes, and there was the list of kind of tax shelters was really long. And as you would imagine, as inefficient as we think our government is, they oftentimes will decide to close those up and take those off the menu of tax planning strategies. So with the Tax Cut and Jobs Act, any big tax reform, they will try to poke away at some of that. So depending on how you earn your income, what your income looks like, sometimes it's like, hey, you got to wait it out and do X, Y, Z in the future. Not to say there's nothing to do and there's not planning that's really important, but in terms of those silver bullet type of tax stuff, strategies, a lot of them have kind of gone by the wayside.
Yeah, so I mean, of the strategies that do exist from a tax planning standpoint, I think a lot of people are, they're used to working with a CPA or a tax preparer who they'll reach out, late winter, early spring, give me your tax documents.
Right.
I'll prepare your taxes for you, but how proactive are you going out to clients with some of these tax planning topics?
We are definitely very proactive. As we said before, we meet with them on a quarterly basis, and it usually starts out with a casual conversation, and some things that, you know, may not be in a tax organizer, that the client may not even think is important, to tell us. Perhaps they bought a vehicle that qualifies for an electric vehicle credit. They purchase new appliances. There's a residential energy credit. They have a lifestyle change or a filing status, or maybe they've always filed the same way year over year, but they've never had somebody utilize, should you do married filing jointly versus married filing separately? So each quarter, when we're asking, you know, what is going on basically in your life, we incorporate that into our tax planning projections. And so we're very proactive in letting clients know, and to go to our Burney tax website to see what's new. In addition to keeping up with all the different tax laws and changes. So I would say we are definitely very proactive for our clients.
Yeah, and just like clients don't like tax surprises, you don't like tax, we don't like surprises either. So we always say, if you're going through a big life event or change,
Right.
selling a business, buying a business, making it like any kind of big maneuver, having that conversation ahead of time can go a long way, because that helps us plan, right? And you know, gives us a longer runway to identify, you know, what we might be able to do to help.
It does. And if you do have some type of change, as Adam said, like, let's say you've come into, you know, you're selling a business and you know you're going to owe tax and you're just going to sit there and hold the money until we file in April, that is not a good idea. The IRS appreciates the money and they require it as you make it. So if you made that money in the first quarter, they want a quarterly estimated payment. They do not want it. Well, they do want it, but you're going to pay a fee on top of it when we file that tax return. And what we also say is included with our fee-based, you know, how we're set up, we do not charge for tax planning. It's all incorporated in what we do. So if you're coming up with an idea or you want to know what's the tax impact of this, before you do it, we want you to run it past us so we can let you know the pros and cons. Is that a good decision or not?
And you always want to pay your tax bill, but you don't want to leave a tip.
Right.
You don't want to over.
Exactly.
Yeah, that's right. That's right. All right. Let me go to the Zoom questions here, because we did have one come in. So the question is, what is a backdoor Roth IRA? So this is this can be sort of a sticky one. So
Yeah.
Adam, why don't you give us your thoughts on backdoor Roth contributions?
So in order to make a contribution to a Roth IRA, you need to have earned income and you need to fall below certain limits, right? So it's for a lot of high income earners, they are boxed out of being able to make a direct contribution to a Roth IRA. And it's a point of frustration, right? Because Roth IRAs are one of the most attractive savings vehicles that you can allocate to. So a backdoor Roth IRA contribution, it involves making an after-tax contribution to a regular IRA, so a non-deductible regular IRA contribution, and then quickly converting those dollars over to Roth. And that is a way to skirt the income limits and to get money from out of your paycheck and into a Roth IRA. There's a lot of other rules and minutiae that go with it that we can coach clients through. But ultimately, and there's some different considerations you need to think about, such as, do you have any other pre-tax IRA money? That's a really big one with backdoor Roth. But essentially what you're doing is you're taking cash, you're putting it into one type of IRA, and you're converting it to a Roth quickly thereafter. And that specific transaction does not have any income limits. And if you could do that over a very, very long period of time, it can look, could turn into something meaningful. But for us, I mean, that's one place to save your money. And part of our job is to look at all the different buckets you have and determine which dollars should go into what bucket and when. But that's generally, I'd say we have some number of clients that do it. I wouldn't say it's terribly common, but
Yeah, we do see, I don't think the majority of our clients do that, but when the topic comes up, we will definitely run the scenarios and show you the pros and cons, should you do it or should you not. But it's very important, there's certain tax forms that go with that type of
Right.
transaction. And quite often that is an IRS notice that when they do this type of activity, the right forms have not been filed with the tax return, which automatically generates an IRS notice. So
Yeah,
we make sure that if you're doing that type of transaction, we've got all the tax forms so that you're not getting surprised by the IRS,
yeah, because another option might be a Roth 401k,
right?
or right, like if you do Roth 401k contribution, you can do a backdoor Roth, you can do any any combination of all the.
Let's talk about 401ks and IRAs then, since you just brought that up. So, when would it make sense to combine 401k, say from a prior job, to an IRA, or when would it make sense to keep would it make sense to keep the 401k going?
We probably have like a similar list of pros and cons, right? So the one benefit we run it, the two main benefits that we run into as it relates to moving money from a 401k to an IRA tend to be simplicity, right? So you've got all these different old employer accounts, and you simplify it, you can roll all of those in many cases into one IRA. And that IRA in many cases is going to have a larger menu of investment options. They can be professionally managed. So we see that right on the investment side.
Yeah.
A lot of, you've got more flexibility on how the money can be managed within an IRA than you do on a 401k.
Yeah, you're limited by your investment options. And I'd say I've seen, 401ks with a great suite of investment options.
Right.
And I've seen them with a terrible suite of investment options.
Yeah.
So sometimes this question really is specific to your individual situation. If you do want to have more flexibility with how your money can be invested, that's when it primarily makes sense to roll out of a 401k into an IRA.
Yeah, and with the 401k, if you think about, well, what about the other end of the fence? Like when might it make sense to keep money in a 401k? It would be if you need to borrow against it, right? 401k allows for loans up to certain dollar values, and you need to use your 401k as a source of funding. That's one. The other is if you personally are subject to a ton of liability, 401ks and in some states offer better creditor protection than IRAs. Not always the case, but in some cases it is. The 401k is like an extra veil of protection, depending on the liability source of the client. But in general, it comes down to simplification and investment flexibility.
And I think too, with the 401k, if you're at a prior job, as Adam said, sometimes if you're currently employed, they're gonna let you take a loan against the 401k, but if you're not employed with that employer anymore, you can't take the loan. So, it's one advantage that goes away.
It depends, right?
Yeah.
Like many things, it depends.
Right.
Unsatisfying, but often the answer, right?
Yeah.
Yeah. All right, so we've got 3 questions left here. One of them is general from an investment standpoint, and 2 are like very specific. So I'll start general and move my way down.
Put your wizard hat on.
What does my crystal ball say here for 2025 market forecast? I would say if you're asking me to make a market forecast, I'm typically going to lean on, what's the historical return? Is it possible we see a 3rd year in a row of 20% plus returns? Yes. Is it likely? I don't know. But at the same time, it doesn't mean I'm calling for a bear market to happen. So, it's typical to have a market correction. So I'll define a correction as a 10% drawdown. That happens about as frequently as you have a birthday. So, market corrections are normal, very healthy parts of bull markets. What's a little bit less common is what we've had now in sort of like, back-to-back times. 2020, we had a bear market with the whole COVID crash. In 2022, we had a bear market with both stocks and bonds. With a 20% fall in equities, even more for growth stocks. That type of scenario is pretty unusual. You can bank on a bear market happening about once every 5 years on average. So the fact that we've had 2 in a 5-year time frame like that back to back, it's fresh. It's in our mind still that can happen, but it's probably not, again, the likely scenario. So do we see 20% return to the upside? Do we see 20% return to the downside? Anything's possible. Not sure how likely that is. I will say it does seem like we're beginning to see a little bit of evidence of this current pro-growth market phase waning a little bit. So if we see more evidence of value stocks beginning to do better, so really again we're going beyond the top growth names like your Nvidias and in Amazons and stocks like that. If we see more evidence of that bottom 490 beginning to step up, I think you'll see us continue to go more towards value. So we're right now, if you were to ask me to bet on what's going to do better next year, growth or value, I would not be surprised to see value make a comeback.
And what's interesting, just like we've said before, we get whenever the market hits a new high, it raises alarm bells. You hear on CNBC or Bloomberg, S&P notches, 30th new high of the year. It tends to get people more nervous and not excited. And what's funny is, like we say, that's actually more of a bullish indicator than bearish. Yeah. And also, there's been a handful of times, not many, but a handful of times in the last 50 years where the market has notched back-to-back 20% plus gains side by side, like we just went through. And the average return in that third year was still double digits, which I thought was interesting. You've never had a negative, kind of third year in a row after that.
The stock market should be making all-time highs.
Yeah,
right?
if you look naturally back, happens.
It just happens. One of my favorite numbers is like, do you know what the S&P 500? So you probably know S&P 500 today is around 6,000 worth level. Do you know what it was back in 1990? It's closer to 100.
That's the nature of the beast. That's crazy. And I think, with that, if you kind of stack all the returns of the last 100 years on a table and plot them out by return ranges, it's funny, we talk a lot about the market, being 8 to 10% per year, but very few of those years actually returned 8 to 10%.
Yeah.
So like the average return almost never happens. It's usually something, you have these windows of a lot higher return, and then you've got lower returns. So you're kind of almost hedging your bet on, are we going to have above average returns or really below average? And I think given all the economic factors we talked about, and the productivity growth in the economy, and just where we are in the cycle and what we've already come out of with it, you count 2018 and that we had pretty much 3 bear markets in a 5-year window. So
yeah, it's true.
That's
yeah. So just because the market's going up, that's not a reason in and of itself to be afraid. There's plenty of good things going on in the economy that are really driving that. So that's a nice positive angle there. I've got 2 very specific questions. I'll probably take these ones unless you guys have any thoughts on longevity research. So I think this is a really interesting space. So longevity technology. There's some really smart people doing a lot of great work. I think of like Peter Diamandis and like David Sinclair as really like pioneers when it comes to pushing the envelope on like anti-aging sort of technology. This question, are there any reasonable risk investments that I can recommend on that front? We are very early innings with this whole field. A lot of the research is being done like at the university level. There are standalone companies that are doing this type of research when it comes to the anti-aging technology, but they're all very speculative at this point. There's huge questions whether or not they'll ever be able to develop a treatment or a drug or what have you that will actually be approved and make it to market. When you look at just the risk profile, you could hit a grand slam. It's more likely that you're going to lose the entire amount of money that you put into one of these companies. That being said, there are like major biopharmaceutical companies that are doing some work here. I think of like AbbVie or AstraZeneca. They're dabbling in it, but these are mammoth companies that are doing so many other things that it's not really a pure play into longevity technology. So I would say that something to keep an eye on at this point. I would consider an investment in this space highly speculative. I think if you were to put money into it, you probably want to be putting money into it. So in the hope one day you can actually benefit from the anti-aging treatments rather than making a lot of money from it.
Yeah, and on the planning side, real quick, this translates to conversations we're having with clients about like longevity. How long should you plan to live, right? You go to retire, you're drawing down your portfolio, you need to know, well, how long am I going to do it for? And unfortunately, no one can answer that question and hit the bullseye on it. So we're, because of this, maybe not on the investment side, but on the planning side, we're saying, hey, it's not going to be long before we're seeing more and more people retire and live well into their early 100s.
Yeah, you could. Yeah, so that's a great point. Something to, there's so many things here beyond just the investments, to think about here. So fascinating area of research, definitely something to keep an eye on. Let me go on to our last question here, which is our thoughts on private equity and private credit part of their overall investment strategy. So yes, these things can be black box, they can be illiquid. They can make sense in certain circumstances. They can also not make sense in others. So what we found in our research for building out our asset allocation models is private equity, the good private equity investments are really hard to access, even for a firm like us, that manages, 3 billion plus in AUM. The best PE funds are, invested in by the huge endowments or, private family offices, things like that with many, many billions of dollars. We just don't typically have access to the top tier private equity. It is something we're actively looking for, though. We haven't given up. Most private equity is just high fee, small growth performance. But we are dabbling in a couple different options there, and we're seeing if we can find an attractive enough private equity investment to recommend for clients. We're not there yet. We're still doing a lot of due diligence. We do a lot of due diligence before we ever recommend anything for a client. And one area where we have done that due diligence, though, is private credit. So this is, I think, a really attractive part of the market. A lot of people were reaching for yield. Just think back a couple of years ago when bond yields were so low, they were reaching for yield with public high yield bonds. And you're just taking on a lot of risk in what's supposed to be like the less risky part of a portfolio. We prefer private credit because there are some risk controls on there, but just the private nature of these investments and the types of firms that are getting financing here, they offer a couple key benefits. One is higher yields than you'll get in the public markets. But two, a big benefit that we saw in 2022 was that, public bonds have like fixed coupons. So when the Fed raised rates aggressively, we saw prices fall. That's interest rate risk. Private credit hedged against some of that interest rate risk because of the floating rate nature of these loans. And so private credit investments actually held up well in 2022 when public bonds fell. Even very safe like treasuries still fell because of that interest rate risk. So we do think that private credit can make, for a good part of a diversified portfolio today. We're still doing due diligence on private equity. Haven't found anything we absolutely love yet. Do you have anything that I missed there, Adam?
Well, there's like a lot of things. I mean, there's many different flavors of private equity and private credit. Specifically as it relates to private credit, there's all types of unique transactional based financing and loans that are issued that are more equity-like in their nature. And then there's the more direct lending to really great profitable private businesses. That's the avenue that we primarily look down with private credit investment. In 2008, post the financial crisis and with Dodd-Frank, there was a lot of great, mid-sized firms that could no longer easily get bank financing and had a lot of red tape, and it just wasn't as accessible and as revolving as they needed it to be. So private credit is it makes a lot of sense when you think about the lending landscape. You think about the size of the economy, the growth of the firms. It is unique, and especially for us when we weigh the pros and cons of that against public high yield credit. Private credit, you get really good, high quality businesses that need financing on a floating rate basis, and it fits into the overall portfolio, to our expectations.
And there is that illiquidity. So,
Sure.
You're the type of person, that you're going to need to be drawing money out of your portfolio. Maybe this isn't the best option for you, but if you have a long-term time horizon and that illiquidity, matters a little bit less, you can, maybe profit a little bit from that illiquidity premium.
Yeah, and it's like anything. It's how much of it what percentage of my portfolio does it represent, and where am I holding it? What account type. So there's unique tax considerations with that as well, but we're always thinking about how do the different pieces fit together, and private credit is a really great complement to things like treasury bonds, equities, and other alternatives.
Yeah, paid off well this year as well. All right, well, that is the end of the questions. I think we were debating before we launched this. Did we have 30 minutes? Did we have an hour? I'm just gonna say that we had an hour because it's 1:20 right now.
Okay.
So we pushed it a little bit. So probably about 10 minutes left. We're probably not going to use all 10 of those minutes, but Rhonda, I want to turn this over to you because as we enter what everyone knows as tax season, I want to give you an opportunity to talk a little bit about Burney Tax Advisors.
Okay, great. So, as we said before, Burney Tax Advisors was launched in, July of 23, mainly for the benefit of our Burney clients. There were a lot of pain points with, the Burney company reaching out to maybe, outside CPAs for their clients to prepare tax returns. And they just thought it would be such a great experience to have, a tax offering under the Burney umbrella to collaborate with investment and wealth management to make it a holistic approach for our clients and a much better experience. So we launched Burney Tax in July of 23. It has been nothing less than successful. Our clients are very happy with, I believe, the offering that's out there. So I think what I said before is what is different for me than being at any other place. Our focus is primarily tax planning. That is where we start out. So we start, if you're interested in learning more about Burney Tax, schedule an introductory meeting with me and our team. We will, review prior year returns, look at where you are. We're looking at long range planning to see if it's a fit with what we do and the other things that we offer here at the Burney Company. So
Yeah,
Did I-
it's more
did I-
solving for a problem than
Yeah.
anything, for us, it would. We get a lot of feedback from our clients. We've always touched the tax conversation with clients in some way, shape, or form. It's whether it's talking about tax forms, with investment accounts, talking about capital gains budgets, or just planning. It's been really, it's been an evolving process, but yeah, the best way to just have an introductory meeting with the tax team is to reach out to your advisor. They'll get you in touch with Rhonda and her group, and it's really just meant to be an open conversation. Look at where you are, see if there's anything that we can do to help or optimize, and it's really for our clients and to make for the best experience possible.
And clearly this season, if you haven't been happy with your CPA and you're just, year over year, they ghost you, things are not going well, you're not getting any education, you're being surprised when you get your tax return. We're here to tell you, the focus is tax planning on a quarterly basis. We eliminate the element of surprise. You pretty much know what your tax liability is going to be, if there is one, when we're going to file the return. We're always available for tax questions. The communication is very easy. We get back to you. I think it's just, you're going to enjoy it. It's probably a much different experience than at least what most of our clients have told us with working with other CPA firms.
Yeah, great. So your advisor on the Burney team is a great resource to talk about that. I think this will be recorded, right?
Yep, it was recorded.
Okay, recorded. We'll probably post this to the website, that along with all the other great resources we put together throughout 2024 and prior years. So, a belated happy 2025 to
Happy New
everybody.
Year.
We've got our investment webinar, next Wednesday, so we'll be
That's right.
back shortly. But please reach out and let us know if you have any questions.
Thanks, everyone.
Thank you.